Corporate debt is a topic that no company director can afford to ignore as we head into 2025. With the rising cost of borrowing and continued economic challenges, businesses are being forced to adapt to a rapidly changing financial environment. Let's break this down and explore how these trends could affect your business and, more importantly, what you can do about it. Rising costs of borrowing. Over the past 2 years, we've seen significant hikes in interest rates as central banks combat inflation. This trend is expected to continue into 2025, making it more expensive for businesses to borrow money or refinance existing loans. For many companies, this means higher monthly repayments, therefore reducing cash flow and increased financial stress. To manage this, directors should focus on renegotiating terms with lenders as early as possible. Banks and creditors may be more willing to work with you if you demonstrate a clear plan for managing debt. If refinancing isn't viable, consider cutting back on discretionary expenses to free up some cash flow. Increased scrutiny on debt levels. Another trend to watch is the growing scrutiny from investors and stakeholders on corporate debt. In 2025, transparency will be critical. Companies with high debt-to-equity ratios may face questions about their financial stability, which could impact shareholder confidence or even supplier relationships. One strategy to address this is proactive communication. So be transparent about your debt and demonstrate how it's being managed. For example, if you're investing in growth areas that will drive future profits, explain this clearly to stakeholders. This can go a long way in maintaining trust. Alternative financing options. With traditional borrowing becoming less accessible or more costly, alternative financing options are stepping into the spotlight. Peer-to-peer lending, private equity, and venture capital are being increasingly used by businesses in order to raise funds without relying on banks. Now, while these options can provide much-needed capital, they often come with some strings attached, such as equity dilution or stricter repayment terms. So, directors must carefully evaluate the pros and cons of these options. For instance, while private equity can bring in significant investment, it often comes with a loss of control. Ensure that you understand the long-term implications of any deal before signing. Sector-specific impact. Some industries will feel the pressure of rising debt costs more acutely than others. Sectors such as retail and construction, which already operate on tight margins, may struggle to stay afloat. Directors in these industries should pay particular attention to their debt servicing ratios and plan for worst-case scenarios. For example, if you're in retail, you could explore strategies such as renegotiating rent agreements with landlords. Or if you're in construction, could you streamline operations to improve efficiency and lower overheads? So what can directors do? How directors navigate these challenges effectively in 2025 is critical to business success. Let's take a look at 3 key steps, 3 key actions that you can take for your business straight away. Number 1, regular financial reviews. Schedule monthly or even weekly reviews of your company's financial health. Look closely at your cash flow, your debt levels, and any upcoming repayments. Early detection of problems is critical. Number 2, build stronger relationships with creditors. Open communication with your lenders can make a significant difference. Creditors may offer flexibility, such as temporary payment holidays or extended repayment terms, if you engage with them early and present a solid case. And number 3, seek professional advice. If you're unsure how to proceed, consult a financial advisor or an insolvency practitioner. They can provide expert guidance tailored to your unique situation and help you avoid costly mistakes. Ultimately, the corporate debt landscape in 2025 will undoubtedly present business challenges, but that also offers opportunities for those who prepare. By staying informed, planning proactively, and seeking the right advice, company directors can navigate rising borrowing costs and maintain financial stability. Remember, debt doesn't have to be a burden. It can be a tool for growth when managed efficiently. If you're looking for help in any area of your business and you like a complimentary and confidential consultation, you can reach out to us today. Somewhere around this video there will be a button or a link. Click on that now and get in touch with us. We're here to help.